On April 5, 1933, the United States government issued Executive Order 6102, compelling American citizens to surrender their gold to the Federal Reserve at a fixed price of $20.67 per ounce. Within 18 months, once the transfer was complete, the government revalued gold to $35 per ounce through the Gold Reserve Act. The citizens who complied lost 40% of their purchasing power overnight. This was not theft in the conventional sense. It was a structural reset, a deliberate recalibration of who holds real assets when the system requires it. What most observers missed then, and what most miss now, is that this was not an anomaly. It was a pattern. Silver is exhibiting that pattern again, but this time the mechanism is inverted. Instead of governments extracting metal from their populations, one nation is extracting metal from the vaults of another. In March of 2024, silver premiums in Shanghai began diverging from London spot prices by margins that had not been observed since the Hunt brothers attempted to corner the market in 1980. By June, the premium had widened to 18%. By August, it exceeded 22%. In some private transactions within Shenzhen and Guangzhou, physical silver changed hands at prices equivalent to $100 per ounce when converted from yuan to dollars at prevailing exchange rates. This was not speculation. It was arbitrage driven by structural scarcity. The London Bullion Market Association reported in September 2024 that vault inventories had declined by 31% year over year. The CME Group disclosed that registered silver inventories available for delivery had fallen to their lowest levels since 2015. Meanwhile, Chinese customs data revealed that silver imports into China reached a record high of 6,200 metric tons in the first half of 2024 alone. The metal was moving in one direction. It was not returning. This is not the first time a rising power has drained precious metals from an established hegemon. Between 1599 and 1660, Spain extracted approximately 16,000 tons of silver from the mines of Potosi in present-day Bolivia. Most of that silver flowed eastward, not to Madrid, but to Ming Dynasty China through the Manila galleons and overland Silk Road routes. Spanish merchants accepted Chinese silk, porcelain, and spices. China accepted only silver. The Spanish crown, despite controlling the largest empire on earth, could not dictate terms. The nation that produced goods, the world desired, controlled the terms of exchange. Spain's silver financed China's economy while Spain itself entered a century of decline, unable to convert metal into sustained industrial capacity. By 1720, the British East India Company faced a similar problem. Britain wanted tea, silk, and porcelain from China. China wanted silver. Britain had little silver and no goods China desired. The trade imbalance drained British silver reserves so severely that by the late 18th century, the company resorted to cultivating opium in Bengal and smuggling it into China to reverse the flow. When China attempted to halt the opium trade in 1839, Britain launched two wars to force the market open. The entire structure of 19th century geopolitics in Asia was shaped by one nation's inability to obtain goods without surrendering metal, and its willingness to destroy another nation's sovereignty to avoid that surrender. The United States faced its own version of this trap in the 1960s. Under the Bretton Woods system, foreign central banks could redeem dollars for gold at $35 per ounce. As U.S. deficits mounted to finance the Vietnam War and domestic spending, foreign governments, particularly France under Charles de Gaulle, began converting dollars into gold. Between 1959 and 1971, U.S. gold reserves fell from over 20,000 metric tons to less than 8,500. On August 15, 1971, President Nixon closed the gold window. The United States could no longer meet its obligations in metal, so it severed the obligation. The system did not collapse, it adapted. The dollar remained the global reserve currency, but it was no longer backed by anything except the promise of future productivity and military enforcement of that promise. China observed that sequence. It learned that the nation which holds the metal holds optionality, but the nation that controls the goods holds leverage. For 2 decades, China has been acquiring metal while building industrial capacity. It now produces 70% of the world's solar panels, 60% of its electric vehicle batteries, and dominates refining capacity for lithium, cobalt, nickel, and rare earth elements. It does not need to defend a currency with metal. It needs to accumulate metal while others still believe currency is sufficient. Silver occupies a unique position in this structure. It is both a monetary metal and an industrial commodity. Each electric vehicle requires between 25 and 50 grams of silver. Each solar panel requires approximately 20 grams. China installed more solar capacity in 2023 than the rest of the world combined over the prior decade. Its electric vehicle production exceeded 9 million units in 2024, representing more than 60% of global output. The demand is not speculative. It is embedded in physical infrastructure that cannot function without the metal. Western financial institutions have treated silver as a hedge, a speculative vehicle, or a secondary monetary asset. They have not treated it as a strategic resource. The London vaults hold silver on behalf of institutional investors who believe their claim to metal is as secure as possession. They trade paper contracts at volumes exceeding physical supply by ratios that, in some months, reach 200 to 1. The system functions as long as delivery requests remain marginal. When a sovereign actor begins requesting delivery at scale, the system reveals its thinnest assumption, that paper and metal are interchangeable. China is not making speculative bets. It is converting financial claims into physical assets at a moment when Western institutions remain confident that liquidity equals security. This confidence has precedent, and that precedent has never ended favorably for the institution that maintained it longest. In 1929, the Bank of England believed its gold reserves were sufficient to maintain the pound's peg. By 1931, it was forced to abandon the gold standard. In 1967, the London Gold Pool, a consortium of central banks attempting to suppress gold prices, collapsed after losing thousands of tons of metal to arbitrage. In each case, the institutions believed they could manage perception while others accumulated substance. In each case, the metal moved before the perception adjusted. The current silver market is structured identically. The paper price is set in London and New York. The physical premium is determined in Shanghai. The gap between them is not noise. It is information. It reflects the cost of converting a financial claim into a tangible asset in a jurisdiction that prioritizes physical delivery. When that gap widens beyond transaction costs and remains elevated for months, it signals that one market is discovering price while the other is managing it. Chinese state-owned enterprises and private refiners are not operating independently. Imports are coordinated, refined domestically, and allocated according to industrial and strategic priorities. The Shanghai Gold Exchange and Shanghai Futures Exchange do not report inventory data with the transparency of Western exchanges. What enters China does not leave. This is by design. The system is structured to accumulate without signaling intent until accumulation becomes irreversible. Western institutions are structured oppositely. They prioritize liquidity, transparency, and the ability to exit positions rapidly. These are strengths in a stable system. They become vulnerabilities when a counterparty is optimizing for accumulation rather than trading. The incentive structure guarantees the outcome. One side is required to provide quarterly earnings, manage short-term redemptions, and satisfy regulatory capital requirements. The other side operates on multi-decade timelines with state backing and no obligation to disclose reserves. History demonstrates that when two systems with incompatible time horizons compete for the same finite resource, the system with the longer time horizon wins. Rome's grain supply was controlled by Egypt for 3 centuries. When Egypt's loyalty shifted, Rome's political stability collapsed within a generation. Britain controlled global coal and steel production in the 19th century, but by 1914, the United States and Germany had overtaken it. Britain remained politically powerful, but its industrial dominance never returned. The lag between losing material capacity and losing geopolitical influence can span decades, but the sequence is consistent. The current configuration suggests a similar lag is unfolding. The United States and Europe maintain financial dominance. They control the currency markets, the bond markets, and the institutional infrastructure of global capital. But China controls the supply chains for the materials required to build the next century's infrastructure. Solar, batteries, semiconductors, and electric motors all require silver. The nation that produces those goods determines the price it will pay for the metal, regardless of what financial markets indicate. This is not a prediction of collapse. It is an observation of rebalancing. The dollar will not disappear. Western capital markets will not cease to function. But the terms of exchange are shifting. The nation that holds metal and produces goods will dictate terms to the nation that issues currency and manages debt. This has happened before. It is happening again. The difference is speed. What took centuries during the Spanish Empire and decades during Bretton Woods is now compressed into years by the velocity of modern capital flows and the transparency of real-time data. There is no conspiracy. There is only incentive. China has an incentive to secure physical resources for industrial development. Western institutions have an incentive to maximize short-term returns and maintain liquid markets. Both are behaving rationally within their structures. The conflict is not ideological. It is structural. One system prioritizes optionality. The other prioritizes possession. When both systems compete for the same asset, possession wins. The question is not whether this will continue. The question is whether Western institutions will recognize the pattern before their vaults are empty. There remains a narrow possibility that policy could shift, that strategic reserves could be rebuilt, that industrial capacity could be prioritized over financial engineering. But that would require acknowledging that the current system is not optimized for the competition it now faces. Institutions do not acknowledge this until the cost of denial exceeds the cost of reform. By then, the metal is gone. The capacity is relocated. The terms have been set. History does not repeat, but it rhymes with precision. And the rhythm, once established, is almost impossible to break. The mechanics of what is unfolding can be traced through shipping manifests, refinery reports, and the widening gap between futures contracts and physical settlement. In the third quarter of 2024, the Shanghai International Energy Exchange reported that physical delivery requests for silver futures exceeded available registered inventory by a factor of 3.7 to 1. Contracts were settled in cash at premium prices rather than metal. This was not a temporary shortage. It was a structural imbalance that revealed a deeper truth about how modern commodity markets have been architected. They were designed to facilitate price discovery and speculation, not to guarantee physical delivery at scale. The London bullion market operates on an unallocated basis for most participants. When institutions or investors purchase silver through the LBMA system, they receive a claim against a pool of metal held by custodian banks. The metal itself is not segregated or specifically assigned. This structure works efficiently when the majority of participants treat their holdings as financial positions rather than demands for physical possession. But it contains an embedded fragility. If a sufficient number of participants simultaneously request allocated metal or physical delivery, the system must either deliver from reserves, purchase metal on the spot market at prevailing prices, or settle in cash. The incentive structure encourages the third option. China is exploiting this fragility without announcing it. State-affiliated entities and private refiners operating under implicit coordination have been requesting physical delivery through intermediaries in London, Zurich, and Singapore. The metal is refined to Chinese standards, shipped to bonded warehouses in Shanghai and Shenzhen, and then withdrawn into domestic reserves or industrial supply chains. Once withdrawn, it does not re-enter international markets. Chinese export restrictions on refined silver, implemented incrementally between 2021 and 2024, ensure that domestic production and imported metal remain within the system. The flow is unidirectional by policy. This is identical to the mechanism Japan employed with oil reserves between 1970 and 1973. Anticipating supply disruptions, Japan quietly accumulated oil through long-term contracts and strategic storage, ensuring that when the 1973 oil crisis struck, its economy absorbed the shock more effectively than the United States or Western Europe. The difference was preparation. Japan understood that access to physical resources during a crisis is determined by decisions made years before the crisis becomes visible. China is applying the same principle across critical materials, and silver is simply the most transparent example because its price is publicly quoted and its supply chain is easier to track than rare earths or semiconductor-grade materials. Western financial institutions have not adjusted their models to account for this. Risk assessments for commodity exposure still assume that liquid markets will remain liquid, that counterparties will honor contracts in metal rather than cash, and that geopolitical actors will prioritize market stability over strategic accumulation. These assumptions held for decades. Under a system where the United States and its allies controlled both the financial infrastructure and the physical supply chains, that configuration no longer exists. The financial infrastructure remains Western. The supply chains have migrated. The consequences are beginning to surface in unexpected places. In November 2024, a major European-based exchange-traded fund backed by physical silver disclosed that it had been unable to source the full quantity of metal required to meet new subscriptions and had temporarily settled with cash equivalents. The disclosure was buried in a regulatory filing. The price impact was minimal, but the event itself was significant. It demonstrated that even large, reputable institutions with explicit mandates to hold physical metal can not always acquire it at the prices their models assume. Industrial users are responding more aggressively than investors. European and American solar manufacturers reported in late 2024 that procurement costs for silver had risen by 34% year over year, despite relatively stable futures prices. The premium for immediate physical delivery had decoupled from paper contracts. Manufacturers began securing supply through multi-year forward contracts at fixed premiums, effectively locking in higher costs to guarantee access. This is rational behavior when the alternative is production halts, but it also signals that the market is fragmenting into two tiers: financial silver, which trades on exchanges, and physical silver, which increasingly trades outside them. The fragmentation creates opportunities for mispricing that sophisticated actors can exploit. Chinese refiners are purchasing silver futures contracts in London and New York at spot prices, taking delivery of physical metal, refining it to higher purity standards domestically, and selling it into Shanghai markets at premiums that, after accounting for transportation and refining costs, generate returns exceeding 15%. This arbitrage should theoretically close as Western sellers raise prices or Eastern buyers reduce premiums. But it has persisted for over 18 months, which indicates that one side is willing to pay above market rates to secure physical supply, and the other side is willing to sell below physical replacement cost to maintain financial liquidity. The historical parallel is the gold-silver drain from Weimar Germany between 1921 and 1923. The Reichsbank maintained official prices for gold and silver, while inflation eroded the real value of the mark. Foreign actors, particularly French and Belgian banks, purchased German metal at official prices using depreciated marks, then sold the metal abroad for hard currency. The Reichsbank continued selling because it needed to defend the mark's nominal value and maintain the appearance of stability. By the time the policy reversed, Germany's metal reserves were depleted. The mark collapsed completely in 1923. The Reichsbank's mistake was not the initial policy. It was the refusal to recognize that defending a financial construct with physical assets creates a one-way transfer mechanism that cannot be sustained once counterparties understand the terms. Western central banks are not repeating Weimar's currency policies, but they are repeating its structural error. They are defending the integrity of financial markets while allowing physical assets to flow outward without replenishment. The assumption is that financial claims are fungible with physical goods and that markets will self-correct before imbalances become systemic. This assumption is being tested. The test is not hypothetical. It is occurring in shipping logs, refinery queues, and the widening premiums between Eastern and Western physical markets. The difficulty with recognizing this pattern in real time is that each individual transaction appears rational. A bank sells silver at spot price because it has no immediate need for the metal and can redeploy the capital elsewhere. A refiner in Shanghai pays a premium because it has industrial contracts that require delivery. A Western ETF settles in cash because sourcing physical metal would require paying above the fund as net asset value. No single actor is behaving irrationally. But the aggregate effect is a system that transfers physical assets eastward while Western institutions accumulate financial claims that become progressively harder to convert into the underlying metal. There is still time for recalibration. Western governments could designate silver as a strategic material and implement policies that prioritize domestic refining capacity, incentivize recycling from industrial waste streams, and restrict exports of unrefined ore. They could require financial institutions that offer physically backed products to maintain higher reserve ratios and demonstrate the ability to deliver metal on demand. They could negotiate reciprocal trade agreements that prevent asymmetric accumulation. These interventions would not require abandoning market mechanisms. They would simply acknowledge that markets operate within geopolitical structures, and when those structures shift, market rules must adapt. But adaptation requires acknowledging that the current trajectory leads to a foreseeable endpoint. That endpoint is not dramatic. There will be no sudden crisis, no televised emergency, no official announcement of failure. What will happen is quieter and more durable. Western institutions will continue operating. Markets will continue functioning. But the terms of exchange will have shifted. The entities that control physical materials will set prices. The entities that control financial infrastructure will accommodate them. This is how rebalancing occurs between powers, not through conflict, but through the slow, persistent migration of leverage from those who manage claims to those who hold assets. The pattern is visible. The outcome is predictable. The only variable is whether those who still have the capacity to respond will choose to do so before the decision is made for them.